TV Gelderland 2021. If you want to invest in the potentially best ETFs, everything depends on your risk profile. We talked about low-risk ETFs such as the Vanguard Total World Stock or the ICRS World Small Cap ETFs, moving to a neutral risk profile, and we can see that here on the screen we naturally arrive at the Vanguard S&P 500 ETF, which is still one of the best ETFs. And the S&P 500 ETF with the ticker VOO is also the cheapest ETF you can find. There are many tickers depending on where you invest, so just take a look at which tickers available in your investment account have the lowest expense ratio. Because in terms of portfolio composition, there are no differences. After all, it is the S&P 500, so they all contain the same stocks. Of course, there are 500 stocks in it. You can also see that they are predominantly all large cap stocks that are in the S&P 500. And there are some issues at the moment, specifically with the S&P 500 due to the sky-high valuation. You can also see that the return on equity is somewhat higher. These are, of course, terms for advanced investors, but you need to learn this if you are going to invest in ETFs, because you can achieve relatively high returns simply by waiting for valuations to improve a bit and then buying more. Now, when you talk about what kind of companies are in this, and of course the geographic diversification is important, you also see that 31% is in information technology, and the largest companies are, of course, Apple, Nvidia, Microsoft, Amazon, Facebook. And this is also why the S&P 500 is such a strong ETF and is considered the strongest index fund in the world today. That is, of course, due to the phenomenal results of these large companies that obviously have sales, not only in America but also worldwide. But still, the geographical distribution remains very limited, as all stocks are, of course, listed in the United States, and the majority of the income that those companies earn also comes from the USA. So that is geographical risk, and you always have to take that into account. A number of interesting traits. The S&P 500 is one of the best ETFs. It is one of the cheaper ETFs, as it is so well known. The second is momentum. The 5-year return was simply 100%. So you doubled your money in 5 years, and that is a higher return than 10% per year. A nice trick, you have the rule of 72. If you divide 72 by, for example, 7, then you have an annual return of 10%. If you divide 72 by 5, it means you have an annual return of about 12.5%. So the S&P 500 has achieved a return of 12.5% over the past 5 years, which is significantly higher than the median of all ETFs. So the S&P 500 performs very well in that regard. It also has lower costs, with an expense ratio of 0.0%, significantly lower than the median of all ETFs. When we look at the dividend grade, yes, it is not a dividend ETF, so that is actually not very special. Then we have the risk grade. You can also see that the standard deviation is in line with the Vanguard Total World Stock. So yes, it actually has the same kind of volatility as the Vanguard Total World Stock. However, there are fewer stocks in it. Still, it is a bit of a risk. Why? An average annual return of the cash S&P 500 is 10%, and that is also based on 100 years. But the stock market over 100 years is, of course, very long. Your time horizon can be much shorter. If it is very short, then you have a problem, because right now the valuation is very high and a correction could easily be 20, minus 30, minus 40%. If it is a crash, it could even be a bit more. But in the very long term, the return of the S&P 500 is potentially attractive. However, be aware, there is a handy website called multiple.com S&P 500 PI ratio, where you can view the S&P 500 PI ratio in relation to the entire stock market. Well, nowadays, past 2020, we have, of course, a very different kind of composition of the S&P 500 with many more technology stocks. We saw that 30% is in technology stocks. These are, in terms of earning models, much better, stronger companies with much more profitability, so a slightly higher price to earnings of 30, or according to the source of the S&P 500, it is 26 or 27, the PE, a slightly higher PE ratio is justified. But historically speaking, the median is 15, and the average is 16. And if the valuation is significantly higher than above 20, then it becomes a bit concerning. So it is quite possible that the phenomenal S&P 500 ETF will decline in the short term. As a passive investor, you can simply deal with that by starting now with a very small amount, and to keep buying more as the funds decline. Only no one knows when that will happen, or if they will decline at all, and how long that will take. Historically, during the corona crisis, the decline was a rapid 30%, But if you zoom out further, in this case, it only goes back to 2011, which is unfortunate because then we look at, for example, 2008 or the dot-com crisis, then you see huge increases in price to earnings ratios and then the declines. The market simply experiences large fluctuations. So an annual average return of 10% for the S&P 500 is possible, but it depends on when you enter and how much you buy during those large declines. That is also the simple tip. If the S&P 500 declines significantly by 20, 30 or 40%, just buy a lot more and hope that in the long term America will have economic growth.